Welcome to the MarketBeat podcast. I'm your host, Kate Stalter, and in this show, we cut through the noise and give you real market insights from professional investors, traders, asset managers, and analysts. Our guests put the market developments in context and give you actionable information to make you a more successful trader or investor. Let's get started. When I learned to trade the markets, there were a lot of systems that had you go into cash in a downturn. Now, conveniently, the promoters of those systems ignored tax consequences, which can be particularly drastic in a taxable account with big capital gains. Now, it's true that a lot of those accounts are now down in value significantly and are even offering an opportunity to harvest losses for tax purposes. But that's not the only reason that stampeding into cash is really a ridiculous premise, particularly in this day and age. We have something today that we did not have 2 decades ago, which is inverse ETFs, which, as the name suggests, return the inverse of the index they track. In today's episode, I bring back a repeat guest, Rob Isbitts of Sungarden Investment Publishing. And Rob is an expert at constructing portfolios using ETFs that give you a better chance of making money in a down market. And as he tells us today, a bear market does not mean you have to give up all your opportunities to profit. In fact, he names several ETFs that are working in the current bear or could offer you a better shot as the market remains in a downtrend. Understanding ETFs, as well as using ETFs to implement a long-short strategy, is something Rob talks about in detail. Even though these products have been on the market for several years, they're still relatively unknown to many investors who are only familiar with individual stocks or with the big ETFs like the SPY, which tracks the S&P 100, or the Qs, which tracks the Nasdaq 100. But as you'll hear today, there's much more than that. Rob names some specific ETFs today, although, more importantly, he gives you a way of developing an investment philosophy for all the different market conditions you will inevitably encounter. You'll get some new ways of viewing the market after today's interview. Here's Rob Isbitts of Sungarden Investment Publishing. So Rob, one of the articles recently that got a lot of traffic on the MarketBeat site was titled, "This Still Isn't a Buyable Bottom for Stocks." And Thomas Hughes, who's one of my colleagues at MarketBeat, he posited that theory using the S&P as the proxy for the broad market, which is fair because that's what most Americans do. What is your take on the current market condition and whether or not we may be near a bottom?
So thanks, Kate. Good to be with you. And first, I would say he's absolutely right. I'd love to meet him.
Yeah.
Because we obviously are looking at the same thing. And if there was ever a time that you can look at the S&P or maybe the Nasdaq and have it really be kind of spread across the whole market or let it be a sign for the whole market, it is now, because things are acting in a highly correlated manner, the likes of which I don't think we've seen too often in my career of over 30 years. And so, yeah, I mean, you can look at risk on and risk off as basically the two investment flavors right now.
What do you mean by that? Because that is a phrase that I hear a lot on CNBC, and a lot of the analysts come on and say that. And sometimes they don't really explain. So for the listeners, what is your definition of that?
Yeah, so I cover about 200 ETFs in my own research. And if you look at almost anything in the equity market, you're going to find that they're all moving in sync with each other. Not exactly, but highly, highly in sync. You are hard pressed to find at the market lows we had recently something that is equity related, an industry, a theme, a sector that is going to behave much differently from the broad market, except maybe it's got a little more beta to it. In other words, a little more volatile. But in terms of finding sort of those needles in the haystack, maybe it can be done in the individual stock area. And I look at individual stocks, but I focus more on ETFs. But even when you get down to sort of micro sectors and themes, they're all kind of moving in the same direction, and they're all telling the same thing. I would almost call this, Kate, a nickels and dimes market, because you get all excited, you make a nickel, you make 5% on something, and then before you know it, you've lost 10. And then you make another nickel, and then you've lost another dime. And before you know it, this is exactly what the S&P and almost every equity chart that I look at looks like, going back to January 4th, the top, and probably even earlier, going back to November, when all this really started to percolate. And, I'm happy to say that I've been basically giving a documented play-by-play of this and almost everything I've said, written, and invested in since that time.
Yeah, and I've certainly noticed the nickel and dime phenomenon. I love that you call it that. In some of the investments in my own portfolio, that they've been up to a certain degree, and then the next day you look at it and it's like, oh my goodness, what has happened here? This was working. How do you suggest that investors handle that situation?
Well, what I would say, first of all, is don't be like Charlie Brown from the Peanuts comics, okay? If you go to my LinkedIn page, you will see that I have pinned a video, the classic video of Lucy from the Peanuts comics. She's holding the football, and Charlie Brown is running up and kicking the football. And what happens every single time in the history of that show? He swings and misses because she pulls the ball away. He goes flying into the air. He yells out something that looks like, AHHHRRRH, okay? Something like that. I mean, I have the spelling right. And he ends up flat on his back. And that's been 2022 for equity investors, and frankly, for a lot of bond investors too. So how do you get around it? Well, the first thing is you have to embrace the idea that investing is not simply trying to profit from the market going up. And that, to me, is the biggest missed education point of investors in my baby boom generation, and certainly those of younger investors too. A portfolio is more than what your latest trade is. And investment success has a lot more to do with running it either as a sports team, as an organizational unit, et cetera. It all works together. And when you have a market like this, you pretty much have to say, all right, as opposed to trying to pick winners in a nickels and dimes market, you really need to focus on getting returns in a very different way than we did in the past. Namely, you have to combine whatever you've done offensively with a defensive component. In fact, and I'm not talking about outright market timing. I'm not talking about we're in the market, we're out of the market. We're in the market, we're short the market, okay? Because that's just guessing. And as a 42-year technician, chartist, since my dad taught me when I was 16, oops, give away my age there, for those who are good at math. So with all those years of charting experience, what I see today as a chartist is that things are not working the way they used to. They still work. Charting is still, to me, the mother's milk of investing, if you will. I don't know if I ever used that phrase before, but to me, it's the truth, okay? It's the truth. Anybody can wax poetic about what they're doing, what they think they're doing. If we're going to have a recession, what is the Fed going to do? Inflation, where's it going to be 3 months from now? Who cares? All you care about is the price of the things that you buy go up and don't go down. And if they do go down, that you take action quickly enough so you avoid big losses. And the charts are clearly telling us now that, yes, as the article you referenced, this is not anything more than a temporary bottom, if it's a bottom at all. And the reason I say that is because I have to look. This is like a Missouri market, it's a show me market, okay? And this market, and again, let's use the S&P as a guide, this market hasn't shown me the ability to do anything other than rally within the same darn downtrend it's been in since early January.
Now, one of the things that you and I have talked about previous to this interview is that you believe the market is still only at a complacency phase, not despondency phase. So what would the difference look like?
Sure. So that old cycle of market emotions that a lot of investors may have seen, if you Google it, you'll actually see a lot of different versions of it that Wall Street has used over the years. I created my own version, which I think is on the first page of Google, which is called the cycle of market emojis, where we put all different types of expressions along with the words. And here's the thing, Kate, when you would think that with the S&P down 20 and the Nasdaq down 30 and bonds down 15 and individual stocks down 70 to 90% if they were high flyers, that there would be some signs that this is sort of grinding to not a halt, but maybe the car that's been going in one direction, okay, the car that's been going south is going to gradually turn around and start to drive north. And it's just not happening. It's not happening because, well, there's a million reasons why it's not happening. Some are in the news, but generally speaking, the equity culture is shifting. It is not simply see stock, buy stock, make money. Buy the dip is gradually being defeated. You would normally expect that after those losses, we would have, if you look at the cycle of market emotions or emojis, you'll see anything like fear, despondency, anger, okay, at what's just happened. I think there's a decent amount of that out there, but I still see more complacency than anything else. I think it's more likely that if you ask an investor how they feel about the market, they will not say, because this is what I see. Look, it can always get better, but this thing could get way, way, way worse in a way we haven't seen in our lifetime. Instead, you'll get an answer like, well, the market's down, but it always comes back, right? Wrong. It doesn't. Sometimes not for many, many, many years. And that's why you have to be more tactical, and you have to be a combination of offense and defense, and you have to basically throw away most past performance of investment strategies before 6 months ago, because we have not ever had this combination of events. People say it was like that in the 1970s. Maybe it was, but you know what was not taking place in the 1970s? You didn't have instant communication where millions and millions and millions of investors around the world were all participating in the markets. You didn't have the transparency. So you can throw that out too. This is just unforeseen territory. I wouldn't say unforeseen, but I would say it's definitely territory that we have not seen. At the same time, you don't have to be an investment expert to figure it out. It starts with being a little more humble, a little more humility, a little less brazen, and learning to be a defensive investor, not just an offensive investor. That's why, again, my sort of tag name for myself or nickname is defensive coordinator for investors.
Not sure what stocks to buy and which to sell? Well, no worries. MarketBeat has you covered. Get the latest buy and sell ratings from Wall Street's top performing, most accurate, and most respected research analysts. That's just one part of what you will receive as a MarketBeat All Access subscriber. You'll also get MarketBeat's new trending stock lists, which monitor social media chatter in real time to help you identify the next GameStop or AMC before you hear about it on the news. MarketBeat All Access also features real-time news, market events, and performance data for your stocks with the MarketBeat portfolio monitoring tool. And you can take a completely risk-free trial for just $1 if you head over to the link we will put in the show notes. You'll get best-in-class stock research tools, performance ratings for Wall Street analysts, real-time news feed, executive support team access, all of this ad-free for just $1 for the first month. Sign up today. The link is in the show notes. Before we get into some strategies to actually make money in this market, and I know you have some ideas for that, and I'm sure the listeners will be very eager to hear that, I do want to touch upon one asset class that you talk about a lot, which is bonds. And I know most of our listeners are more interested in equities and making money on that side. But if they do have a long-term portfolio with an investment advisor, they likely do have some fixed income exposure. And I know that's something that you talk about a lot, is how bonds are not working. You've alluded to that already today. So what are your thoughts on that, Rob?
So, a couple things. First of all, I've been saying for a long time, and again, kind of have the receipts to prove it just on things I've written in a lot of places. Bonds are the worst investment on the planet.
Ever, or just right now?
Right now, okay? They had a very nice run for about 40 years. The run's over. Because your choices are, and look, if you own individual bonds, okay, assuming that the bonds will mature at some point, okay, but all you're doing really is you're locking into low returns with minimal liquidity because the bond market doesn't work the way it used to. The thing is, everything that I say to you or to any group of investors, I would caution that I am less about predicting than I am about sort of understanding and then ultimately rationalizing so you can make cogent decisions. And when it comes to the bond market, this is not our parents' bond market, Kate. Our parents' bond market was the coupon clipping.
Yeah, literally.
So yeah, today the bond market, and treasuries are one thing, okay? Treasuries have some value as long as the U.S. is still considered, the nicest house in a bad neighborhood when it comes to economic policy and, all the issues we've had fiscally, for the last couple of decades. But when you look at the bond market today, it is really controlled by a small number of ETFs. It's all, but just like everything else in our economy, it's all been kind of like Amazon. And I don't mean the stock. Okay. If you want to buy high yield bonds and you're a big hedge fund, okay, or just a big money manager, you want exposure to high yield bonds as opposed to selecting individual high yield bonds. Boom. You buy some HYG or JNK or one of the many other high yield bond funds, and you're in quote unquote high yield bonds. If you want corporates, it's LQD. Well, that, and I think even with convertibles, things like that, preferred stocks, okay, that is not a healthy future for the end investor because it means that flows in and out of these things are going to determine the value of your portfolio. You know what I mean? So when we're looking at the bond market today, you have to look at it almost like they are a different form of equity. And based on the volatility this year, I would say so. Okay. But here's the great news. I may sound like a gloom and doomer, but I've never been more excited than in my 36-year investing career. Never been more excited than right now. And here's why. We have the tools. We have the Amazon, Google, okay, of investment tools. A lot of it provided by MarketBeat, I might add. And when I mean the tools, I mean if you look at the ETF market, and I don't mean SPY and Qs, okay? So let's go back to the topics we talked about. So if you do find a market segment that looks good, okay, biotech looks like it's going to do better than the broad market. Well, in a crappy market, you can buy a biotech ETF and you can buy an ETF that performs opposite of the S&P 500. And I'm not talking about double or triple because those can be poison. But you can simply say, I am long biotech, I am short the S&P 500. And if biotech outperforms the S&P 500, it does not matter if they both go up or if they both go down. All that matters is the difference. Some people would call this arbitrage. To me, it's just sort of pairing up things you like and looking at outperformance of the markets. And when you're looking at the potential, I mean, we had something happen that I don't think has ever happened, or maybe it's only happened a couple of times. 2 weeks, consecutive weeks in which the S&P fell more than 5%. So when you're in that type of environment, the nickels and dimes, you make 5, you lose 10, okay? And eventually it may be you make 5 and you lose a quarter, as in a quarter of your market value, 25%. But it happens faster than this first 20% did. You get into that environment, you can't just say, okay, it's a lousy market. Let me find the best thing to buy, because you're dealing with kind of like what's the best of the losers. And I would much rather be looking at how I can always win in any condition, any environment. And that typically involves a combination of offense and defense, whether you're pairing them up, which is a little more strategy. People need a little more education on, I'm sure. It's intuitive, but it takes a little bit of work and you have to have a method. But you can also simply say, and this is to me one of the most frustrating things about 2022, observing the investment populace, is that everybody seems to think that, well, what can you do? You just got to go to cash. And that's not true.
Right. And that is where a lot of these investing methodologies that were developed a few decades ago, that's what they continue to say. And I've been saying for a long time, that is no longer necessary given some of the products we have available to us today. So you have a methodology that does involve inverse ETFs, which is something that I think a lot of investors and even traders are not very familiar with yet, or if they are, they don't really know how to use them. So can you say a little bit more about that, Rob?
Sure. And look, I give you a lot of credit, Kate, because you are one of the people that's trying to broaden the recognition of these things. Okay. So I think of it this way. If someone were to ask me, well, what can you do in a down market? You just have to go to cash. Well, they're making the implicit assumption that if the market goes down, you can't make money. You can only make money when it goes up. Not true. And so when you have vehicles that are specifically designed to profit when the market goes down, okay, they may decline in value when the market goes up. But again, that's how figuring out how to use them is the key. But the idea that you can't make money in a down market, you can make a ton of money in a down market. And, when it comes to what retail investors and traders are using, in a lot of cases, I see they got the right idea, but they're maybe gamifying it a little bit too much for my tastes. The double leverage, the triple leverage. I'm sure if the SEC would let them, we would have a 20 times leverage. Okay. And look, to some degree, I can see that. I haven't really used them a lot in my own career, but I will say this. If you're choosing between, let's say, that and using options, okay, I can maybe see a case. The problem is I see people sort of gunslinging with these things and saying, okay, I am putting 100% of my portfolio in 3 times long, and then I'm going to go 100% 3 times short. What did I say about the charts before? They don't work the way they used to, something that looks like it's going to work out on a daily or weekly time frame, and it folds, like a cheap suit in, a matter of a couple of hours or a couple of days. That's the nature of today's markets. The market can't hold a rally. And if it's not holding a rally, but it's also not falling through the floor, okay, again, not a bottom, going back to the original question, right? The bottoming process? No, I don't think so. But it's also not falling right through the floor. It's a market that even all the way down here, 20% of the S&P as we speak, you still have the buy the dips has not been defeated to the point where people truly are despondent and they say, I want nothing to do with the stock market. That's when a bear market ends, not when everybody's looking for the bottom. So how do you participate in that? How do you capitalize on it? Well, before I even name names, okay, what if there were a set of investments in ETF form that if you bought them and the market went down, the more the market went down, the more you would make? That would be really cool. Guess what? They've been around for years, but people don't use them enough, or they misuse them by saying, oh, good, can I have 3 times leverage on that? Okay.
Right. And I think the other mistake I see is people treating these as long-term buy and holds for some reason.
Right, exactly. Well, the prospectuses are pretty good on those, right? But the question is, do people read them?
Yep.
So, I mean, if you like, I would say, 3 to 4 different categories of ETF. I wouldn't even call them bear ETFs. I would just say ETFs that can help you make money in a down market.
Okay.
That are specifically designed to capitalize on a down market. Okay.
All right.
So let's start with the basic. Okay. if you want to short the S&P 500, and you're not actually shorting, you're buying a security. So you don't have to worry about margin and all that stuff, okay? You have to watch it carefully, but you don't have to worry about the margin. So symbol SH, look it up, tons of volume every day. SH delivers on a daily basis the exact opposite of what the S&P 500 does. Over time, that can help you or hurt you if the market goes against you. But the point is, if you want to capitalize on, let's say, the next 10% decline or the next 50% decline, well, it's a pretty good arrow to have in the quiver. If you want to do it with the Nasdaq, you can, buy PSQ. If you want to do it with the Russell 2000, the small cap index, it's RWM. And you can use those things as the basis for the arbitrage thing I talked about before. Oh, I think small caps are going to get wrecked, but I think that there are a couple of sectors that may do fairly well. And even if everything goes down together, which they tend to do these days, everything goes down or up together, like we said, well, I mean, if I can simply find something that will beat the small cap index for the next few months, I make a profit. Doesn't matter which direction they go. And taking the directionalness out of this is something that a bear market almost pushes you to do, unless you want to sit there and just pray every night that the bear market ends. And that is not an investment philosophy. That is what we used to call opium. So that's your basic. That's your market go down, ETF go up. Market go up, ETF go down. All right. So it does the exact opposite. That's the sort of pure play. Then you have the ones that are kind of, they have that in it. They're sort of spring loaded. A couple that I have used in the past and that are in my tracking system, a couple hundred ETFs. One symbol is TAIL. And what tail does is it does try to guard against tail risk. 90% of it is in treasury bonds, which means it's great as long as treasury bonds aren't falling with stocks. And the other 10% is in call options, I should say put options on the S&P 500. Okay. And so what happens is that little 10% alongside the bonds kind of sits there quietly in a silent market. Okay. And then when volatility kicks up and the S&P falls or even crashes, all of a sudden tail can take off. And you can look at the history of how it's done. The other one in that category, I would say, is symbol is phdg. It's run by Invesco. It's a little bit on the smaller side, but certainly liquid enough for a lot of individual investors. And PHG kind of takes that 90-10 approach same way, except that the 90% is in the S&P 500 index. The other 10% is in volatility calls, meaning 90% of the portfolio is a plain old S&P index, and the other 10% is in basically profiting from rising volatility. So if the market rises, 90% of your portfolio is moving with it, and the other 10% is kind of waffling against it. If the market cracks really hard, I mean, there have been times this year where the volatility index went up, the VIX went up so much that the little 10% in the VIX calls negated the loss in the 90% that was in the index. That's like, wow, okay. So that's kind of a have your cake and eat it too. There are some environments where it can work against you, at least temporarily, when you're coming down from high volatility to low, because 90% is going up, but the other part is crashing. So you don't make that much. But again, I encourage everybody to do their own research. And then the last class, pretty simple. To me, it's like the non-levered, less speculative, more controlled way to do what a lot of people want to do right now, which is they say, I either want to profit from a big decline or I want to be ready if all of a sudden they call off the dogs and the market goes flying. And the symbols are, well, there's a few varieties of them, but VIXY and VIXY and SVXY, all they do is they buy futures on the VIX or they short futures on the VIX. And I have found that I can use these and not really even have to depend so much on options but here's the thing. They almost operate like options in terms of their volatility. You do not go and put 20, 30% of your portfolio in this unless you're a gambler. Okay. If I have 5% of a portfolio in either one, it's a lot. And you can even use them together if all you are doing Okay. I mean, the thing that made it so that I was profitable in my main core portfolio during the 5-week calamity in 2020, we were up a couple percent. Market was down 34. And one of the biggest things was I just could see the volatility was going to kick up, and that would probably mean a down market, but I just wanted to be on both sides. Well, VIXY, SVXY, that type of combination, if volatility spikes, you got something that's really taking off. If volatility plummets, you got something that's really taking off. You can, even if you hold them long enough and the markets cooperate, you can end up making money on both sides. And if you are a hedged investor in this sense, and you have a chance to make money on both sides of a pair, that's a great thing.
Hey, Rob, thank you so much for offering the listeners some very specific ideas, very concrete ways of approaching their portfolio management during these current market conditions, which could last well into the future, as you're saying. And, it's interesting because the ETFs that you tend to talk about are always, frequently anyway, the ones that are not top of mind for most investors. It goes way beyond the SPY, way beyond the Qs, and I really appreciate that. Let the listeners know how they can learn more about you if they want to find out more about these strategies.
Sure. And thank you. And I would just say this, okay? We take for granted everybody's learned how to play offense as an investor. Not many people have learned to play defense. Again, if you go to my LinkedIn page, you see a lot of my contact information, and it says right up there, defensive coordinator for investors. How am I teaching that? Well, my website is sungardeninvestment.com. We have a lot of things in the works there from a research and service delivery standpoint. And probably the best way, if somebody is interested, you can go to the website and kind of see some stuff. We even have our track record in there, audited track record in the case of some of the models. And it's also just simple enough. Just contact me at rob@sungardeninvestment.com. And I love to talk markets. I'm an investment lifer like you, Kate.
All right. Thanks again. Always a pleasure to have you on the show.
Thanks a lot.
Thanks again for listening to the MarketBeat podcast. Do not forget to subscribe on Apple Podcasts, Spotify, Stitcher, Google, anywhere else you get your podcasts. And you will also find us on MarketBeat.com. If you enjoy the content here, please give us a 5-star review so others can also find all the great interviews and market insights that we bring to you each week. Also, did you know that MarketBeat has a YouTube channel? We sure do. The podcasts are there, as well as tips for getting the most out of MarketBeat and becoming, as always, a better investor or trader.